Your bank account is not a vault. It is a borrower's ledger. The moment you hand your money to a teller, you stop being an owner and become an unsecured creditor standing at the back of a very long line. The marble pillars and polished brass of the industry are designed to maintain a single, fragile illusion that your labor is sitting in a warehouse waiting for you, when in reality, it has already been lent out, leveraged, and transformed into someone else's 30-year debt. This is the invisible architecture of systemic risk, a mathematical game of musical chairs where there are 10 people for every one seat. The global financial framework requires your participation to remain solvent, betting everything on the certainty that the consensus of trust will never vanish. But history proves that when the music stops, the doors don't just close. They bolt from the inside, and the system resets using your capital as the lubricant. What happened to Elias in Vienna was not a tragedy of bad luck or a localized failure of judgment. It was the predictable execution of a legal contract. Most people operate under the comforting illusion that a bank is a warehouse. You imagine a vault where your labor is stored in physical form, waiting for your return. This is the official narrative supported by every marble pillar and polished brass fixture in the industry. But the structural reality is fundamentally different. When you hand your money to a teller, you are not placing it in storage. You are making an unsecured loan to a private corporation. You have transitioned from being an owner to being a creditor. Think about what that means. In the hierarchy of claims, you are at the back of the line. This is the fundamental mismatch between public perception and systemic architecture. The entire global financial framework relies on the inertia of the majority. It requires you to believe your deposit is a safe haven so that the institution can use that capital for its own leverage. This is fractional reserve banking. It is a system built on the mathematical certainty that not everyone will ask for their money at the same time. When they do, the consensus of trust evaporates and the doors bolt from the inside. This is not theory. It is the documented history of every crisis, from the 1907 panic to the 2023 collapse of Silicon Valley Bank. However, a forensic analysis of these failures reveals a recurring pattern. In every collapse, a specific minority has remained untouched. They do not rely on luck or secret information. They rely on 5 structural habits that align their wealth with the laws of physics and contract, rather than the promises of institutions. These habits are not hidden, but they are functionally invisible to the mass public, because the banking system requires your participation to remain solvent. We are going to examine these 5 mechanisms with absolute precision. We will look at how survivors monitor liquidity, translate paper into hard assets, and move wealth across borders to prevent confiscation. This is a study of financial permanentism. Let us be precise about the first mechanism that separates the victim from the survivor. Here is how fractional reserve awareness actually works. To understand why Elias lost everything, you must understand how the machinery of the bank actually functions. It starts with a fundamental correction of your mental model. Most people operate under the comforting belief that a bank is a warehouse. But a bank is not a vault. It is a borrower. When Elias handed over his 50,000 shillings, the bank did not place them in a box with his name on it. Instead, they engaged in fractional reserve banking. Here is what that means. The institution is legally permitted to keep only a tiny sliver of your cash, often as little as 10%, while lending the other 90% to third parties. They take your liquid savings and transform them into illiquid debt. This creates what economists call a duration mismatch, which simply means you can ask for your money today, but the bank cannot retrieve it from a 30-year mortgage or a factory loan for decades. Think about what that means. The bank is essentially a machine that bets on the fact that you and your neighbors will never show up at the same time. It is a mathematical game of musical chairs where there are 10 people for every one seat. As long as the music plays and trust remains, the system appears solid. But the moment the music stops, the 90% that was lent out is physically gone. It is locked in the bricks of a house or the steel of a ship. It is not behind the counter. This structural fragility was the catalyst for the 1907 panic, where institutions like the Knickerbocker Trust evaporated because there was no central entity to provide emergency liquidity. Survivors of these cycles practice fractional reserve awareness. They do not judge a bank by its marble columns, but by its liquidity ratio, which is the measure of actual cash held relative to immediate debts. They know that when the bridge begins to sway, the first people to run are the only ones who reach the other side. You might believe that choosing a bank with higher reserves or government insurance is enough. That is partially true, and we will examine exactly what those protections are worth. But first, we must address a darker constraint, because even a solvent bank cannot protect you from the state itself. A vault full of paper is useless if the paper becomes worthless by decree. Let us look at how survivors translate promises into physical reality. I promise to show you how even a solvent bank cannot protect you from the state or from the evaporation of the currency itself. Let us look at the scale of this physical reality. The numbers from the 1923 Weimar Republic are not just statistics, they are the autopsy of a middle-class civilization. The exchange rate moved from 4.2 marks per dollar to 4.2 trillion. Think about what that means. A life savings that could buy a villa in the morning could not buy a loaf of bread by sunset. Consider the textile worker in Leipzig who received her wages twice a day and ran to the market before the ink on the notes was dry. Consider the retired clerk whose pension of 40 years was reduced to the price of a single postage stamp. In the cafes of Berlin and the woodshops of Vienna, failure was unthinkable until it happened. This was not a story about a single institution. When the Kreditanstalt fell in 1931, it triggered a sequence of collapses across Europe that wiped out the wealth of millions of people like Elias. In the United States between 1929 and 1933, more than 9,000 banks failed. This represented the destruction of $7 billion in deposits. For the average family, this was not a market correction. It was a total deletion of their material existence. Even those who sought safety in physical gold found that the state has a long reach. Executive Order 6102 made it a criminal offense for Americans to own gold bullion, forcing them to sell to the government at $20 an ounce, only to see the price set at $35 shortly after. This was a 40% administrative theft. After these catastrophes, the world demanded a solution. Governments created central banks to provide liquidity and deposit insurance to guarantee your savings. The creation of the Federal Deposit Insurance Corporation and similar schemes globally seemed to provide a final safety net. The public returned to the banks, believing the era of the locked door was over. But this relief is a psychological layer over a structural vulnerability that has merely changed its form. Now you might say that the world has changed since the doors closed on Elias in Vienna. You might argue that we have built a fortress of regulations and insurance to ensure that a 1931 collapse can never happen again. We have the Federal Deposit Insurance Corporation and similar sovereign guarantees across the globe that promise to protect your savings up to specific limits. This is the ultimate psychological anchor for the modern saver. It is the reason you sleep at night while your capital is being leveraged. And for a small localized failure, this system works exactly as advertised. It provides a layer of stability that Elias never had. But here is where the structural reality becomes uncomfortable. Look at the actual numbers behind the guarantee. As of recent reporting, the Deposit Insurance Fund, which backs the trillions of dollars in American bank accounts, holds a reserve ratio of approximately 1.17% of total insured deposits. Think about what that means. For every $100 of insured wealth sitting in the banking system, the insurance fund has little more than $1 in actual liquid reserves. This is not a secret. It is a public statistic published by the government itself. The system is not designed to survive a systemic failure. It is designed to manage a single house fire, not a citywide conflagration. If the fire spreads, the insurance fund becomes a mathematical impossibility that requires the printing of new currency to fulfill, which leads to the very inflation that destroys the value of the savings it was meant to protect. This is the point where survivors transition from trusting a domestic guarantee to practicing what we call jurisdictional separation. They look at history and see that when a state faces a systemic crisis, its first move is to rewrite the contract of ownership. Consider the 1933 gold order again. Those who believed their gold certificates were safe because they were backed by the government found that the contract was conditional. The state did not fail in its own eyes. It simply redefined what was legal to own. This is not a conspiracy theory. It is the documented history of administrative survival. The third habit of the survivor is the understanding that a single jurisdiction is a single point of failure. While the masses in the 1930s were surrendering their assets, a specific minority had already moved their wealth across borders into jurisdictions that were structurally incentivized to protect it. They understood that the only way to protect wealth from a state in crisis is to place that wealth where the state has no legal reach. They moved from being residents of a single economy to being participants in a global architecture of safety. But moving money across a border is only a geographical solution. It does not address the most fundamental risk of all. Even if your money is in a different country, you are still a creditor to an institution. Now that we know why the institutional safety net is a mathematical illusion, we must look at what happens when the survivor removes the intermediary entirely. Let us examine the legal reality of what happens when your bank account is used to save the bank itself. That was the theory. Here is what happened in practice in March 2013. Imagine you are a small business owner in Nicosia, Cyprus. You have spent 15 years building a logistics firm. You keep your payroll of 300,000 euros in Laiki Bank. It is a Saturday morning. You attempt to log into your digital portal to process payments. Access denied. You drive to the nearest branch. There is no crowd yet, but there is a sign. Bank holiday, by order of the central bank. In the next 48 hours, the world learned a new term, the bail-in. Before Cyprus, the standard response to a systemic failure was the bailout. The state used the future productivity of the citizens to rescue the current mistakes of the banks. In 2013, the strategy changed. The institution was saved using the direct assets of its own clients. If you held more than 100,000 euros, the bank did not ask for your help. It took it. At Laiki Bank, depositors saw 47.5% of their savings above the limit simply evaporated. It was legally converted into equity in a failing institution. You went to sleep as an owner of cash and woke up as a minority shareholder in a catastrophe. Think about what that means. This was not a market loss. It was an administrative execution of a contract you never read. The speed of this mechanism has only increased. Fast forward to March 2023. Silicon Valley Bank in California. This was the first true digital bank run in history. In a single business day, depositors attempted to withdraw $42 billion. That is $4.2 billion every hour. $1.17 million every second. The heavy oak doors of Vienna have been replaced by a spinning icon on a smartphone screen. But the structural result is identical. When the liquidity vanishes, the portal closes. The system does not break it. Simply resets using your capital as the lubricant. This is the third and final confirmation of the pattern. Vienna, 1931. Nicosia, 2013. Santa Clara, 2023. The collapse is not a ghost of the Great Depression. It is the operating manual of the modern era. You must realize that the legal definition of your deposit has remained unchanged for nearly a century. You are an unsecured creditor. You are at the back of the line. The bail-in is now codified law across the G20 nations. It is written into the Bank Recovery and Resolution Directive in Europe and the Dodd-Frank Act in the United States. The machinery for the next confiscation is already assembled and tested. The illusion of safety relies on your belief that the government will always step in to provide a backstop. But we must ask the question that the banking industry avoids. If the state intervenes to guarantee the uninsurable, where does that wealth actually originate? If the fire is too large for the insurance fund who truly pays for the rescue, let us look at the hidden mechanism of the state response and the final habit of those who refuse to be the fuel for the next fire. And here is where it gets uncomfortable, because we must address the principle that unifies every failure we have studied. This is the fifth habit of the survivor. It is the application of the Lindy effect to the preservation of wealth. The Lindy effect is a concept which suggests that the future life expectancy of a non-perishable thing, like an idea or a technology, is proportional to its current age. If a book has been in print for 50 years, it will likely be in print for another 50. If a financial instrument has survived for 5 centuries, it is structurally superior to one that has existed for 5 decades. Think about what that means. Survivors do not chase yield in novel digital derivatives or government-backed schemes that are younger than their own parents. They align their wealth with the laws of physics and the endurance of time. They choose the workshop, the timberland, and the physical metal, because these assets do not require a counterparty to remain valuable. This leads us to the final revelation, which is the philosophy of financial permanentism. This is not conspiracy theory. This is structural analysis. We must recognize that the banking system does not suffer from a flaw. It is operating exactly as designed. The design requires a fundamental asymmetry between the institution and the individual. The bank offers you convenience in exchange for your ownership. It provides you with a plastic card and a digital screen that creates the illusion of access. But as we saw in Cyprus and Vienna, access is not the same thing as ownership. Access is a privilege that can be revoked by a central authority in 60 seconds. Ownership is a structural reality that exists regardless of whether the power is on or the bank doors are bolted. The deepest layer of this architecture is the realization that the state and the banking system are not separate entities. They are two halves of the same administrative graph. The state grants the bank the right to create currency through lending, and the bank in turn provides the state with a mechanism to fund its own debt and control the movement of capital. You are the lubricant for this machine. Your deposit is the collateral that allows the state to maintain its consensus of trust. This is why the bail-in is now codified law. The system has reached a level of complexity where it can no longer save the individual without destroying itself. Therefore, it has legalized the sacrifice of the individual to preserve the structure. Convenience and safety are not the same thing. They are often opposites. The more convenient an asset is to spend, the more vulnerable it is to confiscation. The more digital your wealth becomes, the more it resembles a permission-based relationship rather than a piece of property. Survivors like Elias understand that you cannot freeze a relationship that does not exist. By minimizing counterparty risk, they remove themselves from the administrative graph. They do not hide from the economy, they simply refuse to be its fuel. The pattern is already in motion, and the fragility of the system is its defining feature. The only remaining question is not whether the architecture will fail again, but where you will be standing when the consensus of trust finally evaporates. So what does this mean in practice? We have spent this time documenting the structural fractures of the system, not to create paralysis, but to define the boundary between what you control and what you merely access. I am not recommending specific actions. I am documenting the framework that survivors have used to navigate these cycles for over a century. Think about what that means. It is not about what they bought, but how they structured their exposure. The first alternative is active institutional selection, based on liquidity ratios rather than marketing. This means moving capital to banks that operate with higher cash reserves or those that do not engage in the most aggressive forms of lending. The advantage is a lower probability of being trapped in a localized run. The limitation is that in a systemic contagion, even the most conservative bank is still subject to the laws of the central bank and the risk of currency devaluation. Safety here is relative, not absolute. The second alternative is the translation of digital promises into physical reality through assets that obey the Lindy effect. This involves the direct ownership of productive land industrial tools or precious metals held outside the banking system. The advantage is the total elimination of counterparty risk. You do not need a password or a teller to validate your ownership. The limitation is liquidity. You cannot spend a piece of timberland or a gold coin at a grocery store in seconds. You are trading convenience for structural permanence. Anyone who tells you that you can have both at the same time is selling something. The third alternative is jurisdictional separation, which involves placing a portion of wealth in a legal environment that is not your own. This protects against domestic administrative theft, like the 1933 gold order. The advantage is that the reach of a single state is finite. The limitation is complexity and cost. This requires significant capital and legal maintenance that is often inaccessible to the average saver. It is a shield that comes with its own weight. These options do not eliminate risk. They merely redistribute it. They move you from being a passive victim of a single architecture to being an active manager of your own exposure. We must realize that there is no perfect vault. There is only the calculated choice between different types of vulnerability. Let us return to the workshop in Vienna to see the final result of these choices. It is now 1934. The streets of Vienna are quieter, and the bread lines are shorter, but the scars are permanent. Return to the Leopoldstadt district and the workshop of Elias. He is standing at his bench, and the smell of sawdust and beeswax fills the air. He is polishing a piece of dark walnut for a cabinet door. Outside, the world has changed. His neighbor, the lawyer who once lectured him on the efficiency of government bonds, now works as a humble clerk in a state warehouse. The doctor across the street sold his carriage to pay for coal. But Elias is still working. He is not wealthy in the way the speculators once were, but he is whole. He is functional. He is not among the worst off. Think about what that means. Elias did not survive because he predicted the exact day the Kreditanstalt would fail. He survived because he understood the difference between access and ownership. Access can be revoked. Ownership is a physical reality. His silver was not a digital entry in a ledger or a paper certificate held in a vault he could not reach. It was integrated into the very tools of his survival. He recognized that convenience and safety are not the same thing. They are often opposites. By accepting the inconvenience of physical storage and the lack of institutional yield, he gained the one thing the banking system cannot provide: permanence. This is the essence of financial permanentism. It is the transition from being a passive participant in a fragile architecture to becoming a structural survivor. The history of the last century is a sequence of moments where the majority discovered too late that their savings were merely a conditional promise. From the streets of Vienna in 1931 to the digital screens of California in 2023, the mechanism of extraction remains identical. The system does not break. It resets using the capital of those who trusted the illusion of a warehouse. This channel exists to study the fractures before they become fault lines. We do not look for villains or conspiracies. We document the history and the contract law that operates beneath the visible economy. Subscribing is not an act of following a creator. It is an act of positioning yourself with information before the consensus of trust evaporates again. The pattern is already in motion. The fragility of the architecture is not a bug, it is the defining feature. This is not financial advice. This is structural analysis.